I'm curious about it from a liquidity perspective. Nvidia stock has rallied. They're sitting on massive amounts of cash. We're talking a lot about AI and the fundamentals and when we're going to see an actual return on all of this investment, because the time frame seems a little hazy here. How much of the Nvidia rally is really a liquidity story as opposed to a fundamental AI short squeeze story?
Morning. It's great to be on again. I mean, when we're thinking about the ROI on this accelerated compute build-out, it's actually very compelling. So if I'm a cloud service provider investing, say, $1 billion in a data center fit with Nvidia AI kit, this translates to around $4.5 billion over a 4-year time horizon. So that the ROI is very compelling. And when we think about what's drawing that through from an end user perspective, it's the ROI from this AI software. In Microsoft Copilot, this really blew us away. Gartner have done some fantastic research on this. But the ROI for Microsoft Copilot is 1.5 days. So you invest in Microsoft Copilot, you get your money back after just 1.5 days and some. And it's this immediate productivity uplift that we all as users experience that is really catalyzing this arms race by big tech to build out the AI infrastructure. I mean, we see $3 trillion in AI infrastructure spend over the next 3 years based on this demand pull.
So that's the AI story then. We had Matt Bloxham of Bloomberg Intelligence there saying that there's this potential for Nvidia to expand even further, going into CPUs, for example. What does that possibility look like, given its transition from being a gaming company to, or gaming chip company to a AI chip company, basically, has been so enormous and so fast and so speedy? How quickly does that broader expansion happen?
So we are seeing Nvidia already really extend its position up and down the technology stack, innovating to really just continue driving down the cost of compute. And this has involved venturing into CPU territory. You know, we think about the Blackwell, which is Nvidia's newest computing architecture, ramping in the second half of this year. It's using ARM CPUs within that, but this is all part of a much broader innovation. I mean, this super chip has got 72 GPUs, 36 CPUs, all capable of acting as one giant GPU. So it's a long sort of way, that a leap that Nvidia has come from its historic days as a gaming company. But we do continue to expect to see Nvidia really push the limits of innovation around the entire stack. This includes software, hardware. They're doing a lateral move into custom ASICs. Their product innovation velocity is just so far ahead of competitors that really no one else is capable of this vertical integration expertise.
And that's probably, and that sounds great and impressive. I wonder if new product is coming so quickly, and I'm thinking here about Blackwell, does it mean that customers have more reason to pause and not buy the current stuff if the new products come so quickly, and they'd rather just wait another 3 months, 6 months? And that seems to be where some of the news coverage around AWS and its demand for chips from Nvidia has come from.
Absolutely. So, I mean, the key debate going into Nvidia's earnings tonight has been whether we see an air pocket in demand for Nvidia's current computing architecture, Hopper, before the launch of Blackwell in the second half of this year. Now, we don't see that playing out just based on the fact that demand for AI infrastructure is not going away. It's actually being turbocharged. And we've seen this play out this earnings season, most clearly demonstrated in the CapEx budgets of the hyperscalers. These are Nvidia's largest customers, and we're now expecting CapEx budgets here to increase 35% this year. A large portion of this is going to be directed towards Nvidia. And the news story last night that AWS is halting orders of the Grace Hopper superchip has really reignited these air pocket concerns. But it's important to note here that this is just for the Grace Hopper superchip, and lead times are around 2 quarters, 5 to 7 months. So Nvidia already has Amazon's orders for the Grace Hopper superchip for Q2 into Q3, and that really serves as the bridge that we need in order to get to Q4 and the ramp of Blackwell. But also, as Blackwell ramps, it's going to be very supply constrained, just as every single product launch in NVIDIA's history has been, just as most product launches across most industries are. So the vast majority of customers are not going to have the luxury of being able to halt Hopper orders if they want to plough on with their AI roadmaps.
OK, so we've talked to you in the past about the competitive environment, and I know you're pretty confident. You know, you see the competition looking longingly at the kind of situation you describe and saying we want in on that, but you're confident that Nvidia has what it takes to stay the course. AMD trying to catch up, some of the data centre operators themselves trying to catch up with their own chips. Do any of them stand a chance, or if they do, over what timescale?
It's a terrific question, and the custom ASICs markets, which is really the chips that Google and Meta are developing for themselves, these serve for a slightly different use case, and they're really for internal workloads, because if we compare the total processing performance of these chips versus Nvidia's H100, for instance, the H100 is 10 times better, but these custom ASICs are around 8 times cheaper. So when the highest compute workloads aren't necessitated, it makes infinite sense for these hyperscalers to be using their own silicon. But when it comes to providing GPUs to their cloud customers, really merchant silicon remains the gold standard here, and we don't see that going away. So they're very much better on the cost side, but nowhere near on the performance side.
Is the silicon where the advantage is, or is the software where the advantage is? Because at the moment, Nvidia's fantastic at tying those two together. You have the kind of the handshaking between the software and the hardware is so good, and that makes it a very compelling product. Others are talking about trying to kind of break that link with the software that would allow, therefore, other chips to be used maybe more efficiently. In terms of how we think about the future valuation of Nvidia, which one is it based on? And is it based on the assumption that those two continue to be as good as each other? And if there was a crack to appear, would it be in silicon or would it be in software?
So both are important because they work together. But software is actually going to become even more important when we're thinking about training these incredibly large language models. I mean, what Jen-Hsun really emphasised on the last earnings call was that accelerated computing, every single component of this requires software. And this is something that has been missed by a lot of people. Nvidia have obviously been developing CUDA for over a decade and have a lead here. But AMD are making some inroads with their ROCm suite, but it really takes a lot to prize the developers that work within Nvidia's ecosystem out of this. And innovation with software, but given this installed base of developers, is arguably going to be an even more important piece of Nvidia's growth story from here on out.
We were just talking to the CEO of SSE, talking about server farms and how much more electricity, electrons, the AI story is going to create. AI stocks are really expensive, super expensive. Energy stocks are quite cheap. How do I play the AI story in a different way? Are there better ways now to get the kind of the pickup that we're going to see as we go through this process from a stock price point of view, rather than just simply going, it's all about Nvidia?
Absolutely. We see opportunities in energy, in select parts of industrials that are really crucial for this AI build-out. A company that's actually incredibly well-positioned, in our opinion, is Constellation Energy, which has the largest nuclear capacity fit for data centres in the US. The advantage of nuclear is a potential speed advantage here, because you don't have to connect to the grid. These sites are large, operational, and already have existing infrastructure very well suited to data centres, such as water cooling and scale. But really, it's going to this build-out is going to benefit those energy providers, those electrical component companies that have already existing installed bases, because the speed advantage is really, really crucial here. We're talking about, if you can connect a data centre up to a power source 2 years quicker than a competitor, you probably receive around 100% price premium here. So it's install-based champions are what we're after on the power generation side. In terms of electrical components, companies that no one's really paid any attention to for years are suddenly now in favour. A company like Amphenol, they provide the high-speed interconnects for the data centre. They're the market leader here. They've got the best technology. And Nvidia's Grace Blackwell superchip coming to market in this, we've got about $100,000 of Amphenol content. This data center portion of that business is going to continue growing, we believe, at the 30% that it started to over the past year. But it's a very underrated AI story, an unsung hero that no one really ever talks about.
I'm sure they'll talk about it now that you've mentioned it. Claire, I'm having a little bit of deja vu here when we're talking about kind of this acceleration, that we're still having this massive adoption here. Isn't this the exact story that we've heard with Microsoft's Asia business in particular? Their growth is still over 30% quarter over quarter, but the stock gets punished when that growth slows down a micro percent, for lack of a better term. I'm curious when that moment comes for Nvidia. What is the visibility there for someone who maybe doesn't have a 5 or 10-year kind of fund investment horizon, who's actually trading the stock? When does this stock suddenly is no longer, this is the opportunity everybody wants, and is then characterized as, okay, well, now the growth is slowing down, now we need to get out?
So we have a five-year investment horizon, and this accelerated compute build-out, we believe, is a 5 to 7 year sort of time frame. We think that 2027 is going to be sort of the crucial milestone where the first stage of this AI infrastructure build-out really sort of comes to fruition, where we're going to see AI deployment achieved at scale for the first time. And that's where we'll see the majority of data centers really switch to accelerated computing. We've got to see about 100,000 data centers re-architectured in order to accommodate for accelerated computing. AI server penetration was only 10% last year. It's got to go to 30%. But from then on out, we're going to see a PC refresh cycle. We're going to see a smartphone refresh cycle. I've lost count of the number of AI PCs that have been launched just this week. But it's this continuation of this AI infrastructure build-out, which starts in the data center. It then moves to the edge. We then see enterprises adopt. The next wave of growth from 2028 will be automotive for Nvidia. So as long as we don't see sort of these waves dovetailing in sort of dramatic fashion, we don't think that there's a lack of a growth engine for the company anytime soon. I mean, getting in on a shorter term horizon, there's obviously going to be volatility around the stock price. Expectations move up and down. We tend to invest in Nvidia when sentiment is low, and trim it when sentiment is too high.
Okay.